Listen carefully, because what I'm about to share with you could be the difference between protecting your wealth and watching it evaporate in the coming months. While everyone's distracted by headlines and political theater, something extraordinary is happening in the silver market. And if you're not paying attention right now, you're going to miss the biggest wealth transfer opportunity of this decade. Let me paint you a picture of what's really going on. Right now, as I'm speaking to you, there's a structural deficit in the silver market that's widening every single day. We're not talking about a temporary imbalance. We're talking about a fundamental supply-demand crisis that's been building for years, and it's finally reaching a breaking point. Here's what most people don't understand. Silver isn't just a precious metal anymore. It's become absolutely critical to the technology that's supposed to save our planet. Every solar panel that gets installed, every electric vehicle that rolls off the assembly line, every 5G tower that goes up, every smartphone, every computer chip, every medical device, they all require silver. And not just a little bit. We're talking about massive amounts of industrial silver consumption that's accelerating at a pace that would shock you. The numbers tell a story that should terrify anyone who understands markets. Industrial demand for silver now accounts for nearly 60% of total consumption. Think about that for a second. More than half of all silver mined every year goes straight into industrial applications. It gets used up, consumed, destroyed in the manufacturing process. It's not sitting in a vault somewhere waiting to come back to market. It's gone forever. And here's where it gets really interesting. The push for green energy, the transition to electric vehicles, the expansion of solar power, all of these initiatives that governments around the world are mandating and subsidizing, they're creating an insatiable appetite for silver. A single solar panel installation can use anywhere from 20 to 40 grams of silver. Multiply that by the millions of panels being installed globally, and you start to see the magnitude of what we're dealing with. Electric vehicles are even more dramatic. A traditional car with an internal combustion engine might use 15 to 28 grams of silver. But an electric vehicle, we're talking about 25 to 50 grams or more, depending on the model. And as governments push to ban gas-powered vehicles and mandate electric alternatives, that demand is only going to explode. But here's the kicker. While demand is surging to unprecedented levels, supply is essentially flat. Silver production hasn't meaningfully increased in years. In fact, many of the world's largest silver mines are seeing declining output as ore grades deteriorate and easy-to-access deposits get exhausted. The mining industry isn't investing in new silver projects because at current prices, many operations barely break even. Let me give you some context on what this means. The Silver Institute, which tracks global supply and demand metrics, has documented that the silver market has been in a structural deficit for multiple consecutive years. That means more silver is being consumed than is being produced. The gap is being filled by above-ground inventories, existing stockpiles that have been accumulated over decades. But those stockpiles aren't infinite. They're being drawn down at an alarming rate. Think about what happens when you have a commodity where demand is growing exponentially while supply remains stagnant or even declines. Basic economics tells you there's only one direction for price to go, but silver hasn't reflected this reality yet. Why? Because the paper silver market, the futures contracts and derivatives traded on exchanges like the COMEX, has been suppressing price discovery for years. Here's how the game works. Large institutional players, commercial banks, they can create unlimited paper contracts representing silver that doesn't actually exist. They sell these contracts into the market, creating artificial supply that keeps prices depressed. It's a shell game that's been going on for decades, but there's a problem with this strategy. Eventually, someone's going to call their bluff and demand physical delivery. And that's exactly what's starting to happen. We're seeing unprecedented demand for physical silver from retail investors, from industrial users who are worried about supply chain disruptions, from countries that are looking to diversify away from dollar-denominated assets. The disconnect between paper silver and physical silver is becoming impossible to ignore. Let me tell you a story that illustrates this perfectly. Back in the early 2000s, there was a similar situation developing in the palladium market. Industrial demand was surging because of catalytic converters in automobiles. Supply was tight, but the paper market kept prices artificially low. Then one day, A major automaker tried to secure physical palladium for their production lines and discovered there wasn't enough available at the quoted price. The market went absolutely ballistic. Palladium prices shot up over 400% in less than 2 years. We're seeing the early stages of that same dynamic in silver right now. The warning signs are everywhere if you know where to look. Premiums on physical silver coins and bars have been elevated for months. Delivery delays are becoming more common. Refineries are running at full capacity and still can't keep up with demand. These are not normal market conditions. And here's something that should really get your attention. Central banks around the world have been accumulating precious metals at record levels. They understand what's coming. They see the same data we're looking at. They know that when the paper market finally breaks, when the disconnect between derivatives and physical metal becomes undeniable, there's going to be a scramble for real assets. The geopolitical situation is adding fuel to this fire. We're watching the de-dollarization trend accelerate. Countries that have been traditional allies of the United States are diversifying their reserves, reducing their holdings of treasury bonds, and increasing their positions in hard assets like gold and silver. The BRICS nations have been particularly aggressive in this regard. They're building alternative payment systems, settling trade in their own currencies, and backing those currencies with commodities. What does this mean for silver? It means that the monetary demand for silver, which has been relatively dormant for decades, could come roaring back. Silver has been money for 5,000 years of human history. It's only in the last 50 years that we've treated it primarily as an industrial commodity. But when confidence in fiat currencies erodes, when people start questioning whether their paper wealth will hold its value, they return to what has always worked. They return to real money. Now, I want to take a quick moment here because this is important. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, you need to understand that you have options for protecting that wealth. A lot of people don't realize you can actually hold physical precious metals in a retirement account through what's called a gold IRA or silver IRA. I've put together a comprehensive guide that explains exactly how this works, how you can move funds from existing retirement accounts into physical metals without triggering tax penalties or early withdrawal fees. You'll find that in the description below. It's worth looking at if wealth preservation is a priority for you, especially given what we're seeing in these markets. All right, back to what's happening right now. Let's talk about the technical picture because it's absolutely fascinating. Silver has been consolidating in a range for months, building energy like a coiled spring. Every time it tests resistance levels, we see massive paper selling come in to knock it back down. But each time it bounces, the lows are getting higher. That's called a rising wedge pattern, and it typically precedes a significant breakout. The key level everyone's watching is around $32 to $33 per ounce. That's where we saw major resistance in the past. If silver breaks through that level with conviction, with strong volume and sustained buying pressure, we could see a very rapid move higher. Technical analysts are pointing to potential targets in the $40 to $50 range just on the initial breakout. But if the fundamentals I've been describing really take hold, if we see a genuine supply crisis develop, those numbers could look conservative. Let me give you some historical context. In 1980, silver hit $50 an ounce during the Hunt brothers saga. That was a different situation, driven by attempted market manipulation and massive leverage. But here's what's important. Adjusted for inflation, $50 in 1980 is equivalent to over $170 in today's money. Silver would need to more than quintuple from current levels just to match its inflation-adjusted all-time high. Now, I'm not saying we're definitely going to see $170 silver, but I am saying that the fundamental case for significantly higher prices is stronger now than it was in 1980. Back then, it was speculation and manipulation driving prices. Today, it's real industrial demand, structural supply deficits, and a global monetary system that's showing cracks. Think about what happened in 2011. Silver went from around $18 to nearly $50 in less than 6 months. That move was driven by concerns about the European debt crisis, quantitative easing programs, and fear of currency devaluation. But the industrial demand picture wasn't nearly as compelling as it is today. We didn't have the solar boom. We didn't have the electric vehicle revolution. We didn't have 5G infrastructure build-out. All of those factors are new, and they're all massively silver intensive. Here's another angle most people aren't considering. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of human history, that ratio averaged somewhere between 15 to 1 and 20 to 1. Right now, it's sitting around 85 to 1. That means silver is dramatically undervalued relative to gold. When that ratio reverts to historical norms, and it always does eventually, one of two things has to happen. Either gold crashes, which seems unlikely given the macroeconomic environment, or silver explodes higher. If we saw the ratio move back to even 60 to 1, which would still be elevated by historical standards, silver would need to gain over 40% just to reach that level. If it went back to the long-term average of 20 to 1, we're talking about silver prices that would shock most investors. But let's bring this back to what matters for you personally. Why should you care about any of this? Because we're living through a period of unprecedented monetary experimentation. Governments around the world have printed more money in the last few years than in all of previous history combined. That money has to go somewhere. It's either going to chase assets, driving up prices, or it's going to erode the purchasing power of your savings. Real assets, tangible things that can't be printed or created out of thin air, they're the ultimate hedge against this kind of monetary chaos. And silver, because it's both a precious metal and a critical industrial commodity, offers a unique combination of protection and upside potential. Let me tell you what smart money is doing right now. They're not waiting for confirmation. They're not waiting for silver to break out and make new highs before they act. They're accumulating positions while prices are still relatively suppressed. They understand that by the time the mainstream financial media starts talking about the silver story, by the time it becomes obvious to everyone, the easy money will already be made. I've been watching this market for years, and I can tell you that the setup we're seeing right now is extraordinary. You have fundamental supply-demand imbalances that are undeniable. You have technical patterns that suggest a major move is imminent. You have geopolitical factors that are driving demand for hard assets. You have monetary policy that's destroying confidence in fiat currencies. All of these factors are converging at the same time. And here's the thing about silver that makes it particularly interesting for regular investors. Unlike gold, which trades at over $2,000 per ounce and requires significant capital to build a meaningful position, silver is accessible. You can start accumulating physical silver with relatively modest amounts of money. A single ounce of silver costs less than a nice dinner out, but that same ounce could be worth multiples of its current price if even half of what we're discussing comes to pass. The industrial users of silver are starting to panic. I'm hearing reports from people in the supply chain that major manufacturers are trying to lock in long-term supply contracts, willing to pay premiums above spot price just to ensure they have the metal they need for production. That's not normal behavior. That's the behavior of companies that see a crisis coming and are trying to get ahead of it. Think about what happens when one of the major tech companies, one of the solar panel manufacturers, one of the electric vehicle producers, publicly announces they're having trouble sourcing silver for their production lines. Think about the signal that sends to the market. It would be an admission that the supply situation is even worse than most people realize, and it would trigger a rush into physical metal that could overwhelm the available supply almost overnight. The COMEX, the exchange where silver futures are traded, they claim to have massive amounts of silver available for delivery. But when you dig into the numbers, when you look at how much of that silver is actually available versus how much is already spoken for, the picture gets concerning. There have been multiple instances in recent years where the exchange has had to change rules, adjust margin requirements, do whatever it takes to prevent a delivery squeeze that would expose the fact that there isn't enough physical metal to back all the paper contracts. This is the house of cards we're dealing with, and it's not a question of if it collapses, it's a question of when. The laws of supply and demand are immutable. You can manipulate markets for a while. You can use derivatives and leverage to create the illusion of abundant supply, but eventually reality asserts itself. And when it does in the silver market, the repricing is going to be violent and swift. I want you to think about your own situation for a moment. How much of your wealth is tied up in paper assets? Stocks, bonds, cash in the bank, retirement accounts invested in mutual funds? All of those things are denominated in currencies that are being systematically devalued. All of those things are subject to counterparty risk, the risk that the institution holding your wealth fails, or the system itself breaks down. Physical silver eliminates counterparty risk. When you hold a silver coin in your hand, you own it outright. It's not someone else's liability. It can't be hacked. It can't be frozen. It can't be confiscated with the click of a mouse. In an increasingly digital world where your wealth exists as entries in a database, there's something profoundly reassuring about owning real, tangible assets. And let's talk about the upside potential here, because it's not just about protection. If silver does what the fundamentals suggest it should do, if we see a move back to historical norms in terms of the gold-silver ratio, if industrial demand continues to surge while supply remains constrained, we're talking about potential returns that dwarf what you could expect from traditional investments. Imagine if you had recognized the opportunity in oil back when it was trading at $10 a barrel and everyone thought it would stay low forever. Imagine if you had bought real estate in 2009 when everyone was convinced the housing market would never recover. Imagine if you had accumulated Bitcoin when it was trading for a few $100s and the mainstream dismissed it as a fad. Those were generational wealth-building opportunities, and they all had one thing in common. They were obvious in hindsight, but they required conviction and action when the opportunity was actually available. Silver right now is presenting that same kind of opportunity. The data is there. The fundamentals are there. The technical setup is there. What's missing is the recognition from the broader market, and that's exactly when you want to be accumulating a position before everyone else figures it out. The clock is ticking because these supply-demand imbalances don't resolve themselves peacefully. They resolve through price. And when price starts to move in a commodity market that's been suppressed for years, the moves can be explosive. We've seen it happen in other markets. We've seen palladium, we've seen uranium, we've seen lithium. In each case, the fundamentals were screaming that prices were too low, but the market ignored the signals until suddenly it didn't. And then prices went parabolic in a matter of months. I'm not telling you to bet the farm on silver. I'm not telling you to take reckless risks with money you can't afford to lose. What I'm telling you is to look at the evidence objectively and ask yourself if it makes sense to have at least some exposure to an asset that offers both protection and explosive upside potential. Ask yourself if it makes sense to own something real, something tangible, something that's been recognized as valuable for thousands of years, in a world where paper wealth is being created at an unprecedented pace. The people who are going to benefit most from what's coming are the ones who act now, while silver is still affordable, while physical metal is still readily available, while the mainstream is still ignoring the story. Once this breaks out, once the supply crisis becomes undeniable, once prices start moving, it's going to be too late to build a position at reasonable levels. This is your moment. This is your opportunity to get ahead of one of the biggest moves in commodity markets we're likely to see in our lifetimes. The fundamentals are aligned. The technical setup is primed. The geopolitical backdrop is supportive. Everything is pointing in the same direction. The only question is whether you're going to recognize it and act, or whether you're going to look back in a year or two and wish you had paid attention when you had the chance. The clock is ticking. The supply deficit is widening. The industrial demand is accelerating. The paper market is showing cracks. And the opportunity is right in front of you. What you do with this information is up to you. But don't say you weren't warned. Don't say you didn't see it coming. Because the signs are everywhere, and they're getting louder every single day.